Investing is a journey that evolves with time. One of the most critical aspects of that journey is how you allocate your assets. As you move through different stages of your life, your financial assets, risk tolerance should allocate equally towards your asset allocation. Now, let's get to what is an asset allocation. Asset allocation refers to the strategy of distributing your investment portfolio across various asset classes. This can be stocks, bonds, real estate, cash, etc. The goal is to balance your risk and reward, and your portfolio should be structured according to it. The right mix of these assets can help you achieve your financial goals while managing the risk that you're willing to take. Now let's look at how your asset allocation changes as you get older. Your asset allocation should ideally evolve as you age, reflecting your changing financial needs, goals, as well as your risk tolerance. Now, let me give you a general guideline of how the life cycle of your asset allocation usually looks. Let's look at the first phase, the early 20s to early 30s. Early career and career development is what this stage is usually characterized by. In your early years, time is often on your side. With decades ahead before retirement, you can afford to take a little bit more risk. A typical allocation might be 80% in equities and the remainder in bonds or other safer investment classes. This is usually facilitated by your ongoing EPF and your PPF deductions. Your mid 30s and 40s, this is usually your peak accumulation phase. As you enter your 30s and 40s, your career often skyrockets and you're able to earn a lot more. You may start thinking about your long-term goals like buying a house, children's education. These are often the goals that is characteristic of this age. While growth is still important, you might begin to reduce risk by slightly increasing your allocation to safer instruments like debt. A common allocation could be 60 to 70% in equity related instruments and 20 to 30% in safer products. Now, as you get older and as you age, let's say maybe you're in your 50s, preparing for retirement, this is the late career phase. You're winding down your career or maybe you're looking at starting another venture, but usually your career winds down. Retirement is no longer a distant goal, so preserving your wealth becomes often a priority. At this stage, a more conservative approach is very advisable. A typical allocation might be 40 to 50% in equities and the rest in safer asset classes. Let's look at the retirement phase now, which is 60s and beyond that. Now you're comfortably retired. As you approach and you enter retirement, the focus shifts more to preserving your wealth and generating income out of it and allocating some towards your portfolio growth as well to account for the inflation. Your portfolio might lean towards more income producing investments such as bonds and debt funds and things like that to ensure that you have proper income. And allocation of maybe 30% to equities with the rest in maybe safer instruments like bonds and debt instruments which will give you a proper income is often how your asset allocation typically looks like. Now, coming to a very important question that people often ask me, why should my asset allocation vary by age? The primary reason someone's asset allocation should change with age is that your financial goals and risk tolerance evolve. So, your asset allocation should also evolve with it. In younger years, you have a long time horizon which allows you to ride out the ups and downs of the equity market. As you get older, your time horizon shortens and you have less time to recover from potential losses. So, reducing risk by allocating to safer investments becomes crucial. Another factor is income needs. As you get older, as you approach retirement, the need for growth becomes less, the need for income becomes higher. So, you'll need more investments that produce you income. Now, let's look at how a proper asset allocation can help you achieve your goals. A well-planned asset allocation can significantly achieve your ability to achieve your financial goals. If you look at aligning your portfolio along with different stages of the life that we previously saw, you can maximize growth while also making sure that all your commitments are met. A proper asset allocation often gives you some of key benefits. For example, achieving long-term growth. If your portfolio is highly allocated towards safer instruments, there might not be proper growth in the portfolio. So, having a proper asset allocation ensures that you have safety as well as growth in your portfolio. Managing risk. If you allocate too much towards equity, you might not be comfortable with the downside that equity comes with. So, having a proper asset allocation helps you to digest this risk properly. Now, coming to another point that often people talk to me about is ensuring a steady income. Having a part of the portfolio that grows and having a part of the portfolio that generates your income can significantly help you in the later stages of your life. And lastly, your asset allocation should evolve with life changes. As you know, life is often unpredictable. The circumstances change. Adjusting your asset allocation ensures that your investments remain aligned with your goals and risk tolerance. In conclusion, life cycle investing is often about making informed decisions that evolve with you as well as with your evolving needs. By understanding and adjusting your asset allocation as you age, you can confidently navigate the financial journey, ensuring that your investments often work for you at every stage in your life.